The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
U.S. corporate earnings confront worldwide market angst. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in New York. And you can see that on this Monday, even though it's a big week ahead of us, we are rallying right now on the S&P 500. Not quite at session highs, but pretty dang close, higher by about 0.6%, nearing all-time highs. The small caps, we've been watching that unraveling. Of course, small caps have been the outperformer year to date. That cracked on Friday, continuing to crack today. The Russell 2000 down about 0.4%. But the cross-asset picture really interesting today. You take a look at gold above $5,000 an ounce, currently higher by about 0.9%. At the same time, you take a look at the Bloomberg Dollar Index, remain off by about 0.4%.
Yeah, different asset classes saying different things with the global market upheaval continuing into the new week. It may not look like it if you just look through the lens of the top line equity index performance, but under the hood, you have a domestic basket of mining stocks that's actually outperforming the broader market for a fifth straight day, and a global index that's outperforming for what would be a fifth straight week. Copper and aluminum, gold and silver climbing in a re-upping of the debasement trade from 3 months ago, where investors pulled away from the U.S. dollar, pulled away from treasuries, and sought refuge in hard assets amid the fiscal and geopolitical uncertainty.
For several years now, market participants have been looking for an alternate reserve currency to the U.S. dollar. You're seeing that in gold now.
And of course, the flip side of that is the dollar. The Bloomberg Dollar Spot Index sliding for a third day, down more than 1.5% over that stretch, worst three-day loss since mid-April. The yen, the dominant outperformer amid speculation of joint intervention by the U.S. and Japan, speculation that's pushed the premium to position for a weaker dollar to a record cost. Now, it's an interesting setup for fundamental investors who are trying to focus on what is the second busiest week of the earnings season based on the number of companies reporting. While energy and industrial companies make up the largest number, the biggest and most impactful names are going to be where else in the tech space? Apple, Microsoft, Meta, SanDisk, KLA. Not just a read on the health of each company, but potentially a read on the health, Katie, of the AI build-out.
Well, let's just talk about the calendar a little bit more, because this week it is stunning. January 28th, this Wednesday, we're going to get Microsoft, Tesla, and Meta. And may I also point out that Wednesday is Fed Day. It's going to be interesting to see what actually drives the market narrative. And Wednesday, that's not the only story here. Then you take a look on Thursday, we get Apple as well, and then we get into some of the other names. But remember what we saw last week with Intel reporting on Thursday, I believe it was. And then on Friday, we had that 17% plunge. And the big worry, taking a look at the reaction, was all about Intel's spending. So that CapEx spend, have to imagine, Romaine, that is going to be one of the questions that investors are asking as we get deeper into this calendar.
Absolutely. Well, let's ask those questions to Dan Niles, founder and portfolio manager at Niles Investment Management, kicking us off to the close. And Dan, I'd be remiss in not pointing out, when we talk about a lot of these big tech names, a lot of them are way far away from record highs. Apple hasn't hit a record high since early December, I believe. Microsoft since October. And I think you have to go all the way back to August of last year, the last time Meta was at a record high. Yet heading into this earnings season, expectations still seem high for what they're going to post in terms of earnings growth and revenue.
Yeah, I mean, I think it's going to be interesting to see how the market investors react to it, because there's pluses and minuses for all the names that are reporting this week, and it's one of the most difficult earnings seasons in my mind that we've seen over the last few years, because there's no clear direction in my mind of how the stocks are going to respond. So let's take them, one at a time. If you look at Tesla, you can say, well, we all know the numbers have got to come down because the EV tax credits expired at the end of September in the US, but you know that Elon Musk is going to talk about robo-taxis and autonomous robots and energy storage and full self-driving. I picked up my new Tesla this Sunday. I love it. But the numbers are too high. So what does the market focus on, especially at these valuation levels? And, Microsoft, similar situation where, the numbers are going to be good because OpenAI is growing so fast, but the losses associated with OpenAI are also going to go up a lot.
Yeah.
And with Meta, similar situation. Numbers are going to be fantastic, but the CapEx numbers, with Meta Compute announced earlier this year,
Yeah.
are going to go up a lot. We've seen Oracle stock get destroyed and be down 45% from its highs based on that.
Well, let me stop you there on Meta, too, because, I mean, that's probably really emblematic. I mean, we saw this the last earnings three months ago when they reported, again, blockbuster numbers on the revenue side, even to a certain extent on profitability. We saw the shares plunge more than 10% because everyone was so hyper-focused on those costs. And I'm wondering if that is the real story over these next couple of weeks when these companies report. It doesn't matter what the growth rate is of everything else. People are going to be more focused on the growth rate of those costs.
Exactly. And also, how do you monetize that? Because if you look at names like a Google or an Amazon or Microsoft, you go, they already have big cloud businesses and that they can sell that capacity to other customers. Meta doesn't have that. They're going to have to build that. And then they're going to have to go, up against those guys who already have big established businesses. And then you throw Oracle in on top of that. So you look at Meta and you go, well, it's really, they're in a tough spot because of it, but how much of that's discounted in the stock? And the numbers are going to be really good, or I think the numbers are going to be really good based on the strength of the ad market and how well they're doing in that. And so it'll be, well, is this like the day Oracle reported when the stock was up a lot? Or is this like the next 3 months when the stock gets almost cut in half? And I'd rather stay away and just see where the dust settles. As the saying goes, the market has to keep pitching, but you don't have to swing.
Well, Dan, outside of just Meta, when you think about all of this CapEx that's planned, I want to talk about how it's being funded, because you are seeing a lot of these hyperscalers really tap the bond market and issue debt in order to fund some of these ambitions. That was a big story this time 3 months ago, pretty much. How are you thinking about that dynamic as we await some of these key numbers?
Well, I mean, I wrote about it this weekend, but I've got short positions in a basket of names associated with private credit because I think what we saw at Tricolor and First Brands and the defaults there and the pressures that caused, I don't think we're done yet. And I think you're going to see somebody before the end of the year have a big problem with one of these data center deals because for right now, all of these names are getting funding. I think by the time we get to the end of the year, you're going to find out that some of these names are not going to get the funding because not everybody that's associated with AI is going to win. You started to see that change at the end of October, obviously, with kind of the Google ecosystem of companies up about 20% since then, whereas the OpenAI ecosystem of companies such as Oracle or SoftBank, NVIDIA, et cetera, they're down about 20% since the end of October. So that's why I worry that as we get towards the end of this year and we figure out, well, these guys are winning in enterprise and those guys are not, and and the same thing in consumer, I think you're going to see a continued shakeout in the AI trade. And that's why we have a basket on that. And also Japan as well, where we've got some shorts around that because, we've seen what can happen when the bond market goes into conniptions and up 41 basis points in 2 days with Japanese bond yields on the 40-year, that certainly qualifies. And it's something you need to think about and to snap elections on, I think, February 8th.
Right. No, absolutely. We certainly saw the ripple effects coming from Japan for our bond market last week. But I want to go back to that basket that you have when it comes to public and private credit names and the short that you have on. It's interesting that you're focusing on the credit names there, the credit providers, rather than the tech names themselves when it comes to those short positions. Talk us through the logic there.
Well, I mean, I think the thing is that the credit side of it is more likely to see pressure in my mind where you've seen, for example, look at NVIDIA. It's trading at 25 times earnings and the S&P is trading at 22 times. Yet you're looking at the companies, if you believe the estimates, revenues are going to be up 57%. So it has really been arguably beaten down in the sense that the revenues, earnings forecasts have gone up, but the stock hasn't done much since late October. And so I think you're seeing in some ways more of that discounted in those names where the credit related ones, I think you could see a lot more damage being done. And so some of it's, we've got some longs in AI equities, we've got some shorts in AI equities, but the credit shorts and the Japan-related shorts are what we're trying to use to hedge the portfolio. And quite honestly, we're just trying to take down risk into these earnings because, as I said earlier, you can make a case for them being up big on the other side of earnings or down big on the other side of earnings. And I'd rather see where the dust shakes out. And normally I have much stronger, views on how these things are going to trade. But, we saw with Oracle, if it was all about the numbers, the stock wouldn't have been almost cut in half since, September highs.
Yeah, absolutely, Dan. Always great to get you, too. And, of course, on that last point, too, of course, still a lot of concerns right now in the private capital space, not even just related to AI, particularly with that drop we're seeing today in BlackRock TCP. Dan, great to talk to you. Dan Niles, founder, portfolio manager over at Niles Investment Management, kicking us off to the close here on this Monday afternoon. We go from the tech market to the foreign exchange market. That was the talk of the town over the last few hours. We're going to follow that trajectory of the yen and what it means for the dollar with Carlos Fernandez-Aller over at Bank of America.
Then we'll keep a global perspective and dive into tariffs, trade, and all things political with Sarah Bianchi. She is Chief Strategist of International Political Affairs and Public Policy over at EverCore ISI.
And of course, it is Fed week. The Fed says it's listening to the labor market, but what is the labor market actually telling us? A conversation up ahead with the founder of Revelio Labs, Ben Zweig. Stick with us. This is The Close on Bloomberg.
Well, the state of Texas is issuing disaster declarations for 134 counties ahead of a major winter storm. Forecasters are predicting ice, snow, and temperatures in the state to drop, making this one of the toughest tests of the electric grid since a deadly 2021 collapse. Here to discuss is Julie Fine. She is Bloomberg's Texas Bureau Chief. Julie, it's great to have you with us. So I mentioned a little bit there about the concerns about the grid, especially ahead of these freezing temperatures sticking around. Where would you say that the greatest pressure points are right now?
Well, I think the greatest concern is always about the grid. And I think a lot of that is because many people here lived through 2021. Many companies lived through 2021. The grid, though, has held. If you look on their dashboard, which many people do, and it lists where everything is, the reserves are in good shape. Right now in Dallas-Fort Worth, about 8,000 people are out of power, and the people served, it's more than 4 million. So right now, less than 1% are out of power. That is not a grid issue. Those, of course, are localized outages that can happen when there is ice on power lines. But overall, I think the grid is in good shape as of right now. People are somewhat taking a sigh of relief, but again, we are still under freezing temperatures in Dallas. We're just above freezing in Austin. So there's another day of this.
So how does this compare to maybe what we saw a few years back when we kind of saw a breakdown in the grid down there? I know there was a lot of, at least publicly, it seemed to be a lot more preparation this time around, including some of the demands to make sure that there was backup power available for some of the more essential services.
Yes, there was a lot of change in the legislature following 2021. They did take some action. For example, data centers, they have to offload in a situation like that so that there's plenty of power available. Some gas facilities, they have done more weatherizing. As you saw this past weekend, some of the refineries set up flares. That's actually a safety measure to show that something's going wrong. So things here have proceeded the way that they are supposed to. The question, though, is we are under freezing for another 48 hours. That is very unusual here.
What does that mean potentially for some of the oil producers and the oil refiners as well, Julie?
Well, as the oil futures traded lower as much as 0.9 on Monday. So obviously they look at things like the refineries. They look at things like flares. However, the freezing temperatures are supposed to be over by tomorrow in the next 24 hours or so. So that's a good sign for them as well.
All right. Julie, I am curious here, too. Once we get to the other side of this, do you anticipate that there could be additional changes? I mean, we talk about that previous storm that you had. So much has changed. You talk about, obviously, the explosion in data centers, the build out of oil and gas infrastructure down there, and just a lot more companies moving to the state of Texas. I am curious about some of the longer term preparations to make sure that the grid can not only withstand these extremes like we saw this weekend, but more importantly, just the ebbs and flows going forward.
Romaine, the Texas legislature meets every other year. It was a major part of the legislative session that does not meet this year. It will meet next year. last year talked a lot about data centers and all of the new changes that come along with them. I do anticipate this to continue in Texas. These problems are not going away. We have these freezing storms every couple of years. More people are moving here. There's a bigger demand on the electric grid. So yes, I expect in the legislative session this to continue to be discussed.
All right, Julie Fine, our bureau chief down there in the state of Texas, keeping a close eye here on those freezing conditions in a state, of course, not used to those freezing conditions and how the infrastructure holds up. When we come back, we're going to turn back to the technology space with a slew of big tech earnings up this week. But we want to check in on Cisco. They don't report this week, but they did get an upgrade from EverCore that could have broader implications for the broader tech sector. That conversation coming up here next on The Close. This is Bloomberg. Time now for our top calls. Big movers on the back of analyst recommendations. And we start off with Meta. Rothschild Redburn seeing a disconnect between the current stock price and long-term value, upgrading to buy, raising the price target to 900, and recommending investors capitalize on any weakness that comes out of the company's earnings report on Wednesday. Those shares up for a fourth straight day. Next up, let's take a look at CoreWeave. D.A. Davidson upgrading the Neo Cloud company to buy, lifting the price target to 110 from 68. This is NVIDIA makes an additional $2 billion investment into CoreWeave to ramp up AI computing capacity by 2023. Those shares up for a second day. And finally, Cisco. EverCore ISI upgrading the maker of networking equipment to outperform, also taking the price target to 100 from 80. The analyst says the stock is an attractive asset and that there are plenty of tailwinds to ensure Cisco can sustain high single-digit sales. Those shares up a fourth straight day, actually having its best day since at least mid-November, and those are some of our top calls. We do want to stay on that last one and get a better read here on exactly what led to that upgrade. Amit Daryanani joins us right now, Senior Managing Director covering the IT, hardware, and communications equipment sector over at EverCore ISI. All right, Amit, I mean, I know Cisco's kind of had a little bit more of a resurgence, or at least the perception of a resurgence amongst investors. What exactly is driving that?
Yeah, in our opinion, it's two things, and the combination of these two things are enabling them, I think, to show you high single-digit sales growth, but also low to mid-teens EPS and free cash flow growth, which I think continues to be somewhat underappreciated. Now, those two things that are helping them, I think, one is a campus refresh cycle, right? One of the big products, the core networking products that Cisco makes, is enabling internet access in campuses and commercial buildings. They just refreshed that entire portfolio. The last time they did this was about 8 years ago, and when they did it the last time, you had multiple years of outgrowth with you at the cusp of that happening again this time. So a good campus product along with a new product cycle will help you there. The second part really has been around the AI momentum that this business has built up. They're on track to do about $3 billion of AI revenues right now, sort of between AI Silicon One, which competes with Broadcom to provide silicon for AI customers, and then the optical solutions and pluggable switches that they provide on the optical side. But that AI business, which is $3 billion of revenues, about 6% of the portfolio, we think can sustain 30-35% growth over the next several years, and can add another point or 2 points of revenue growth to the overall Cisco model.
One thing I've always been curious about this company, I mean, they've kind of been dinged in the past for this idea of being more of a cyclical company. They sell hardware, or at least, actual physical things that you don't necessarily need to re-up, every other week. I am curious as to whether they've done more to build out that services business to create some sort of reoccurring revenue to sort of fill in the gaps in that cyclical cycle.
Yeah, I mean, if you look over the last 5-6 years, they've absolutely done what you're saying, which is they have built a much more of a reoccurring subscription-based model, really to help dampen the cyclicality you see on the top line, right? And probably one of the better places that have done that is on the security side, on the software collaboration side, where they've built up quite an extensive portfolio that tends to be a bit more reoccurring, a bit more predictable in nature. That's one part of it. The other part I would say that they've done is they've diversified the customer mix pretty well, right? 5 years ago, Cisco was really heavily a telco-centric business with some enterprise exposure, for example. Today, they actually have really good enterprise presence, really good telco presence, and a really good cloud presence. So they've actually diversified the verticals a fair amount on the product side, and then they've built a really good security subscription model, more on security offerings as you go forward.
And Amit, I also want to get your thoughts on another big news item of the day, and that is NVIDIA investing an additional $2 billion in CoreWeave. So again, they have this existing relationship. This partnership means that basically CoreWeave is going to build and then operate data centers which will run future generations of NVIDIA's AI systems. The criticism here, or the concern that's been raised, is that this is basically vendor financing or circular financing, whatever you want to call it. I wonder what you made of that announcement.
Listen, I get the references to circular financing and the worries people have. What I would say is, like, if you think about it simplistically, CoreWeave has a bit of a duration mismatch right now. So they will go to certain places like a Core Scientific or one of these companies and say, give us space for a data center. And these data center operators typically sign 15 to 20 year duration leases, right? But at the same time, CoreWeave's customers, as good as they are, only sign 4 or 5 year leases. And so if you're a data center operator like, again, Core Scientific or any of the other ones, you start looking to say, do I really want to extend more money, more credit to CoreWeave when there's a duration mismatch that's there? I think having a backstop, having NVIDIA as a guarantor, certainly can smooth that transaction out for CoreWeave, right? And I think that's really what they're trying to do. I would say from a CoreWeave perspective, this enables them to lower the cost of financing. It shuts down the duration mismatch that they have in a very nice way. And from NVIDIA's perspective, it actually gives them a really good diversity angle. So NVIDIA is less driven by the big hyperscalers, and CoreWeave can actually give them an vantage point and angle to perhaps have a more diversified customer base and get these AI tools in the hands of enterprises over time. So I think there's a little bit for both of them to do, but it certainly makes sense for CoreWeave to have a lower cost of financing post this announcement.
All right, Amit, great to get some time with you. Really appreciate it. That is Amit Daryanani. He is Senior Managing Director over at EverCore ISI. Really interesting, this news. Obviously, CoreWeave shares higher on the day. They did soar overall in 2025, but we know that there was some rough sledding there.
Yeah, he seemed to be kind of pushing back on the whole Ouroboros concerns here. The idea that, I mean, we know it's circular, but the idea is what's the structure. I hadn't really thought about that duration gap. I have to go and kind of double check that, what he said, but that would maybe explain some of these investments in a light that's maybe a little more favorable to investors.
Yeah, well, rest assured, we're going to be talking about snakes in the tech earnings to come. But coming up next, we're going to talk about currencies, specifically what's going on with the yen. Don't go anywhere. This is Bloomberg.
.30 p.m. New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Katie Greifeld. We're keeping an eye on these equity markets, also keeping an eye on what's going on in the currency market, particularly when it comes to dollar-yen, which at least for right now is has the yen strengthening by about 1% versus the dollar. Yeah,
there's been a lot of activity over the last 72 hours. We kind of saw it on Friday. We saw a little bit again overnight coming out of Japan's hours into the U.S. Clearly, a lot's going on under the hood. This isn't just traders sitting at their desk moving it. There's obviously a much bigger hand at play, and it's raising a lot of questions as to what the implications, the longer-term implications, are going to be.
Yeah, especially it's interesting to see Japan and the U.S. seemingly working together here. Longer term, though, it's going to be interesting to ask questions about effectiveness. With currency intervention, it doesn't necessarily have a great sustainable track record here. But I mean, looking at dollar yen, the price action that we've seen in the past couple of days, definitely currency traders are responding. Yeah, and if you are a currency trader, you certainly know what's going on. But for the rest of us, let's try to make a little bit more sense here of exactly what has transpired over the last few days. Joining us right now is the co-head of Global FIC Macro over at Bank of America, Carlos Fernandez-Aller. Great to have you here. Thank you very much. All right, let's go back to Friday, because that seemed to be, I think, the more meaningful move, at least based on what some of the reporting is. This was intervention to some degree or another. Explain what happened. The U.S. and Japan, to some degree or another, decided that they were going to help prop up Japanese assets to a certain extent at the expense of the U.S. dollar.
That's correct. And there's a word that you mentioned before that is very important, effectiveness. I think this was the most effective intervention I remember. And let me give you a little bit of background. When a central bank intervenes, what they try to do is to move the currency as much as they can with as little reserves as possible. They picked a very good time for that. They picked New York on a Friday at midday when London is gone and we were already getting ready for the snow. But something very peculiar happened, something that has not happened, in my opinion, in 20 years. It was not them, it was not the Bank of Japan doing it. The Fed, sounds like they called several dealers asking for a price for dollar-yen. Mm-hmm. That is a complete change on how dynamics in the market happen. And obviously at that point, several $1 billion traded in a few minutes. The currency moved 2%. Mm-hmm. That's a very big move. And this is important, again, the very effective intervention, but it may be signaling a change in policy from the Fed. These coordinated interventions, again, we don't remember since, I think, 2002?
Yeah, but it raises a question as to, at least from the U.S.'s perspective, what the benefit is. Are they advocating for a softer U.S. dollar?
Yes, the question is how. I think the first thing that they're doing here is they're sending a very clear signal of several currencies that are like too weak, that they are not going to allow this weakening. And generally, they are signaling as well, although this is interpretation, that they may want, or they may be okay with a weaker dollar. At the end of the day, a weaker dollar achieves similar results than tariffs, but in a completely different kind of, with a completely different dynamic. So that's why today the market, the dollar was trading very poorly. Mm-hmm. After, you think about that, the last 5 months, the dollar has not been moving. I'm
curious, though, when those calls were going around, because we heard from someone on our show on Friday who said that there were those calls going around. I mean, what was your reaction? Was the reaction by traders concern, panic? Were they welcoming of it? What?
I think the first reaction is this real? Is this a mistake? Because, again, we have not had these calls in a long time. And I think the second reaction is, well, this may be a change in policy. Mm.
I am curious, though, as I mentioned, about the long-term effectiveness. Because if you zoom out when it comes to dollar-yen, I mean, that 160 level, we've gotten close a few times. We got through it when it comes to 2024, at the end then of 2024, the start of 2025. Even though we are seeing this big, dramatic reaction right now, and currency traders apparently, following orders here. I mean, how long can this last?
But that's the thing about it can last quite a long because of the way this is done. As you mentioned, in 2024, when it was reaching 160, they had to intervene, I think 6 or 7 times. Each one of them, they were using $5 to $10 billion. They have $1.3 trillion of reserves, so they can keep on going for a while. But more importantly, I don't think they even spent any reserves in this intervention. Mm-hmm. If you have the support from the Fed, technically it has infinite dollars, they can put the line in whatever level they want. Now, there's a question as well, there's a point in which your fundamentals are misaligned with your currency, so that's another topic. But again, I will not bet against a cross of the 160.
Mm-hmm. Okay, so I do want to extend this conversation outside of just dollar-yen, because you think about the dollar as a whole, trading against other EM currencies as well. Not that Japan isn't EM, but how do you see it stacking up when you think about some of the fundamentals in the U.S. right now and the Fed's plans?
Yeah, we generally are negative the dollar. We think the dollar still has to correct. I don't think we'll correct at the same speed as it happened at the beginning of last year. And when we pick off favorites on what to choose, we think this may be the year for EM. And we are particularly very positive on things like Brazil, like Turkey, countries with very high rates, with improving fundamentals. At the same time, when it comes to, we love several currencies in Asia, Korea being one of our favorites. And as a result of what happened in Japan, I think the pressure from China to appreciate the currency is going to become bigger. So we still think the renminbi will strengthen from here.
I understand, particularly given your job, this is all technically good. It gives you an opportunity to make some good investments. From the perspective of other folks, particularly in the U.S. market, and I don't mean just in the FX market, but folks in equities and even to a certain extent bonds, is there a risk that they should be paying a little bit more attention to?
Well, a weaker dollar, technically at this point, should help the equity market in the U.S. So if you think, what are the reactions from the FX into equities, that should be a positive. I would be more worried the other way around. If for whatever reason there is a risk of, if equities in the U.S. go down, that may be accelerating the speed of the depreciation of the dollar. Because generally, and that's a trend that has happened for many years, the world is very long dollar assets. If there is a need to sell these dollar assets, the impact in the currency, again, this is what we saw in April last year.
And so are traders going along with this? Because the last few times that we saw the yen spike, I mean, there seemed to be some big pushback by traders as far as against that defense, against that supposed intervention or whatever it was. Have they just kind of accepted what happened over this weekend and said this is now the new world order to an extent?
I think traders at this point, we have all realized that you never fight the BOJ. And at that point, again, this is like they have $1.3 trillion of reserves. They can keep on intervening way before you lose your patience.
Yeah, and it's like, no, fight the Fed, don't fight the BOJ. Carlos, great insights, as always. Carlos Fernandez-Aller is now the co-head of Global FIC Macro over at Bank of America. When we come back, we turn back to the equity markets and take a look at one of the biggest movers, USA Rare Earth. It actually had been up about 20%, now up about 6%, forging a big deal for the U.S. government to take a big stake in that company. That's our stock of the hour, and it's up next. This is Bloomberg.
Well, it's time now for our stock of the hour. USA Rare Earth shares soaring on news that it signed a non-binding agreement with the Commerce Department for $1.6 billion in funding to boost production of rare earth elements on domestic soil. Now, this news comes on a day where silver and gold are also soaring, and traditional metal miners are rallying along with it. Bloomberg News' Joe Deaux is here to unpack it all. And let's start, of course, with USA Rare Earth. It has USA in the name. Now you have the government making this investment. What does the U.S. government see here that they're willing to pony up $1.6 billion?
Bottom line is they see what we're calling a mine-to-magnet supply chain. USA Rare Earth has been around for a long time. But they've made a recent acquisition of a UK company, LCM, that really kind of bolstered this idea. Essentially, what the deal says is that USA Rare Earth will be able to mine heavy rare earths out of the ground at a deposit they have in Texas. They'll be able to take those rare earth oxides and turn them into metals, which is what LCM does. And then they'll pull that over to their magnet making facility in Oklahoma and create permanent magnets. And obviously that's the ballgame, right? That's the thing that we're talking about all the time, whether it comes to defense applications or data centers.
So, I mean, how far away are we, Joe, from actual production and, more importantly, revenue? I mean, this is a company that's still relatively young, 6 or 7 years old, and at least based on the data we have on the Bloomberg terminal, not really generating any revenue at all.
That's right. I think when you go through the press release and then the call that they had today with investors, you know, there are numbers of 2028, 2030. I think the idea is the entire mine-to-magnet process would be fully functioning at commercial scale by 2030. But listen, Romain, it's like you said, I mean, these are going to be the questions. This is the risk in the game, and this is what the government understands the risk it's taking and what investors understand as well, which is not everything goes to plan. And listen, I'm not saying that not everything will go to plan. I am saying that this is the risk inherent in any of these deals that we're seeing from the federal government in the critical mineral space. And the question that we'll need to get through is how quickly can the company build out the mine itself, Round Top in Texas? I mean, it's still just a mound of dirt. And then, of course, how are they going to scale up the recent purchase, the LCM purchase that they did back in the fall? And ultimately, what is the permanent magnet production going to look like at their Oklahoma facility? These are questions that I know the CEO is already trying to answer. And clearly, there are enough investors, as we saw with the $1.5 billion that they got from private funding, as well as the government, who believe that this thing can work.
Well, it should be pointed out that, of course, the government has also made an investment in MP Materials, which is currently the country's only rare earths miner that's currently producing. The hope here, as you've outlined, is that USA Rare Earths will get there in short order. But I am curious, Joe, I mean, just put this into context, why the government is so focused on these heavy rare earths in a national security context.
The heavy rare earths are really the most important for the permanent magnets used in defense applications. We spent years talking about light rare earths. Those were the permanent magnets used for things like electric vehicles and the EV transition. But these heavy rare earths is something the United States is short on, right? The MP deal, I mean, MP Materials was really focused on the light rare earths. One of the big things they agreed to in their deal back in the summer was that they would begin to procure more heavy rare earths. This is something the Pentagon understands that the U.S. is short on. This is something the administration understands very well that it's short on. And that is one of the big bets here in USA Rare Earth, that the Round Top Texas deposit does actually get you heavy rare earths. And if you can get those out of the ground and turn them into the permanent magnets that go into defense applications, that begins to wean you off what is your single source supply chain right now, which is mostly China.
All right, Joe, really appreciate your reporting. That is Bloomberg's Joe Deaux breaking down this latest investment from the U.S. government, but certainly this is a playbook that the administration has developed with MP Materials, Lithium Americas. The list goes on. Coming up, we'll take you to the closing bell with Jason Pride. He is Chief of Investment Strategy and Research over at Glenmede. This is The Close on Bloomberg.
It's one of the most difficult earnings seasons in my mind that we've seen over the last few years, because there's no clear direction in my mind of how the stocks are going to respond. So let's take them, one at a time.
Dan Niles kicking us off to the close just about 50 minutes ago. A mixed day on Wall Street with a strong bid coming into some of the big cap tech names, but not a whole lot else.
Yeah, and this, again, it really feels like a waiting period. We have to get through today, we have to get through tomorrow, and then we pack so much in on Wednesday. When you think about the big tech names taking the stage, also the Fed decision.
Taking the stage, that's what I was going to say. What do you think is going to be more important, the Fed at 2 p.m. or those earnings after the bell?
I have to imagine it's going to be the big tech names.
Yeah.
I mean, you just think about, as you made the great point to Dan Niles, that a lot of these names, they've been sort of treading water since they hit their highs at the end of last year, and we've been looking for direction there. When you think about the Fed, though, I mean, it's all about who is going to be the next Fed chair versus what they're actually going to do on Wednesday.
Are we going to get an announcement this week? I think I asked you that last week.
I didn't have an answer, and I still don't, but I hope so. It seems like, again, that short list is pretty short at this point.
All right. Well, we'll see. A lot for investors to digest this week. A very busy week for earnings with more than 100 S&P 500 companies reporting. Also, of course, that big Fed meeting on Wednesday. Jason Pride joins us right now, Chief of Investment Strategy and Research over at Glenmede, counting us down to the closing bell. And I do want to start off, Jason, with the Fed meeting, which is kind of being relegated to kind of a second-tier status because of all the earnings. But we're not expecting, at least based on the pricing in the markets, a move on interest rates. But there could potentially be a lot of drama, not just around Powell, but you have kind of a new slate of voting members. I'm curious as to what you expect to hear on Wednesday, and more importantly, what the longer-term ramifications might be for the markets.
Right, and it's not uncertain or not unusual to see a Fed meeting take a back seat, particularly after the pace of Fed rate cuts that they've put in place heading into the beginning of this year. But it is an interesting meeting nonetheless, because the Fed had two dissenters, one on each side at the last meeting in different directions, right? And those dissenters kind of lay out that argument where we see this slight imbalance here in the way the economy is setting up, where you have kind of I say a weakish, not like a really weak, but a weakish job market, but inflation that is actually still running at numbers are a little bit higher than what people would generally like to see, right? And when you pair those two things together, it sets up for an interesting debate. Now, this meeting will probably produce zero in the way of rate cuts. For this meeting. In fact, the next rate cut based on markets isn't expected to come about until June timeframe. But it also coincides with a couple other things. Number one is that change in committee that you're talking about. Mm-hmm. And number two, we have a pending new Fed chair that will be coming in as well. So between that composition and changing of members and the change in Fed chair, there's actually a lot of change within the Fed. And people will be trying to read the tea leaves in terms of where that means interest rates are headed.
Well, speaking of reading the tea leaves, there's been a lot of hay made over what exactly is the state of the economy. We've seen the official data. Based on that, it does look relatively stable, though clearly there are some pockets of concern. The other issue, though, too, is also the potential of market instability. And a little bit earlier, we were talking about the state of private credit. There's a story on the Bloomberg terminal today about a BlackRock TCP fund that's just plunging today because of concerns about 100% loss, or excuse me, not a 100% loss, but a potential loss that they took on some of those assets. And it gets to this idea as to whether we have a clean read as to what's actually going on out there.
Yeah, look, I think when we see the data, quite often we're in these circumstances where there's a lot of kind of data on different sides of the potential outcomes. And that causes confusion when people are trying to interpret it. But at the end of the day, I think the Federal Reserve and the typical economists are actually trying to aggregate these data pieces together. When they look at it in whole, we're looking at an economy that we think is actually in pretty good shape. It's lifting up at the beginning of this year because of the magnitude of fiscal stimulus. And the balance of risks between kind of inflation shooting up and employment moving a little bit lower are, while they point in opposite directions, they're relatively balanced, leaving the Fed in a position where they really kind of just need to kind of step back and wait for the data to develop and make their stance at a later point in time when the data supports those moves on a more consistent basis.
And Jason, I'd love to get your thoughts on what could happen, should we get a Fed chair announcement this week? As I mentioned to Romaine, I mean, you take a look at the short list. It seems like there's two serious candidates at this point. You have Rick Rieder of BlackRock, and then you also have Kevin Warsh. I mean, how do you think the market would react to either of those two names, assuming that President Trump doesn't come out with, a dark horse sort of pick?
Yeah. Look, just until maybe a week ago, Rick Rieder was considered a dark horse sort of pick at that point in time, at least by betting markets. I think if you turn to how the Fed's going to, or how the market's going to perceive this, of the remaining candidates, the top 3-4 candidates, they were actually very, very credentialed candidates. If you pick through the last two that are sitting there, Kevin Warsh and Rick Rieder, Kevin Warsh is very well known in the marketplace, in the economic spheres, has been there for a while at the Federal Reserve. Rick Rieder is while he may have been a dark horse before, he is the hardest working, one of the smartest fixed income players on Wall Street. Both of those are very bona fide to lead the Fed. And I think the market will look at that and see a lot of credentials coming to the fore, with both of them being very strong candidates. I think markets will probably favor the one that is closer to them, which is Rick Rieder, but probably not be disappointed with either.
Yeah, no, it's a good point, too, that you think about Rick Rieder's, his candidacy here. It was really a late surge, just in the last few weeks, that it feels like it got more serious. So either candidate, in your view, would be welcomed by markets here. Do you think it's that either pick would go far enough, just the pick alone, to put to bed some of the questions and concerns about Fed independence, or do you think that will linger?
One of the shifts recently, I think, in shifting towards Rick and to Kevin Warsh was actually a shift a little bit more towards Fed independence. The move down in probabilities or likelihood of a Kevin Hassett was likely in a reaction to the administration shifting in direction where they didn't obviously put somebody into seat that was as aligned with the administration at that point. I mean, it's not to say that Warsh or Rieder would not be able to align themselves with the administration, but they are considered, at least generally speaking, to be a little bit more distant and therefore fit that role of being a little bit more independent in thought process.
All right, Jason, always great. Jason Pride, Chief of Investment Strategy and Research over at Glenmede, counting us down to these closing bells. Here on a Monday afternoon, a mixed market here with the S&P up about 0.5 percentage point on the day. The Russell 2000 down by 4 percentage points, 0.4 of a percentage point on the day. A full breakdown of all of today's market action, it starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here alongside Katie Greifeld, taking you through to that closing bell with the global simulcast. It starts right now. Carol Massar and Tim Senovic join us right now as we welcome our audiences across all of our Bloomberg platforms, including television, radio, our partnership with YouTube. The calm after the storm, Carol Massar, literally and figuratively, when it comes to financial markets right now as we await a very busy week.
Yeah, and that's where I want to go. I was looking at the Mag 7. They are up only about 0.2% so far here in 2026. It is a big week. We've got 4 reporting: Meta, Microsoft, Apple, and also Tesla. And today we're just seeing them higher by about 0.7%. But I do feel like what we get from them will certainly be important to market momentum and also the market narrative.
What about what we hear on Wednesday from Fed Chair Jay Powell?
Oh, yeah, there is that.
The questions at his press conference. You could probably take a wager. Sorry, not a wager. You could probably predict something on one of the
You could probably
websites.
take a wager,
Be
right?
careful.
On,
No,
is the
you
first
can't,
question
actually.
going to be about a DOJ investigation or about the path of interest rates?
Yeah,
I don't know.
I have to imagine that Fed Chair Jerome Powell will try not to say too much about anything, really, but it is interesting when you think about, the trajectory of markets from here, the sentiment of the week, whether or not it's the Fed meeting or whether it's the big tech names that are going to be more important to determining that. And I don't know, Romain and I were just having that conversation. It feels like it's big tech that this is their week to shine.
It was interesting looking at some of the notes out by analysts this morning. They're really expecting a bit of a broadening of the earnings picture. The idea that it's not just going to be those big tech names to watch, but some of the others that might actually post more meaningful and, more importantly, more significant earnings and revenue growth that might actually help to keep the rally going. We do have a modest rally on our hands on this Monday afternoon, concentrated in mostly some of those big cap names. The Dow Jones Industrial Average adding 300 points or 0.6%. The S&P up about 35 points or a half a percentage point on the day. The Nasdaq adding 0.4%, while the Russell 2000, that's going to finish in the red, down about 10 points or 0.4%.
All right, back to the S&P 500 I go, and we definitely did have some upward momentum among the large caps. 317 names in the S&P 500 higher on this snowy Monday. Katie, 185 to the downside, one unchanged.
Well, if you take a look at the sectors as measured by the circle, you certainly had more green than red. In terms of what led from a percentage perspective, communication services was at the top. Big moves when it comes to Alphabet, when it comes to Meta. Tech, you can see they're taking up a big slice as well, utilities, financials, et cetera. In terms of what didn't perform on this Monday, consumer discretionary down about 0.7%. You also had consumer staples and real estate just finishing just barely in the red, Carol.
All right, so let's go do something that we've been talking about. I'm assuming you guys too. Rare earth companies, they were definitely
Magnets, Carol. Magnets.
Magnets. They were definitely on the move today. This on news that USA Rare Earth signed a non-binding agreement with the Commerce Department for $1.6 billion in funding, the latest White House deal to boost production of rare earth elements on domestic soil. So you did see USA Rare Earths definitely moving to the upside, up about just shy of about 8%. I do want to point out, though, we did look at the whole space, and many of the names, whether it was MP Materials or Lithium Americas, they rallied but then dropped lower and actually sold off a bit. We talked with our own Jacob Lawrence here at Bloomberg, who covers this space, and he said, little company, they're in the very early stage, which you see with a lot of mining companies, yet to be known what kind of rare earths they have. It's a non-binding agreement, so it's basically the White House saying, we'll give you money depending on how this pans out. But nonetheless, it was definitely on the move in today's session. Also moving higher, CoreWeave. So we'll flip it on over to that. NVIDIA, as you know, dominant maker when it comes to AI chips, investing an additional $2 billion in the cloud computing firm. It's also a key customer of CoreWeave, which got us all talking once again about circular financing. So that is something that we kind of keep front and center. You can see that stock, though, CoreWeave up about 5.7%. It's up more than around 40% year to date. It is down more than 30%, though, since mid-August. So we know this one has been under some pressure, but still up pretty mightily here in 2026. GameStop. Thank you, Tim, for this
You're
one.
welcome.
He's like, Masser, do you have your gainers? He's like, you got to do this one. GameStop up about 4.5%, rallying on heavy volume. Michael Burry saying he's buying shares. He said this on Substack. He goes, I own GameStop. I've been buying it recently. I expect I am buying at what may soon be a 1x tangible book value, 1x net asset value. And he says, getting a young Ryan Cohen investing and deploying the company's capital and cash flows, perhaps for the next 50 years. I am not counting on a short squeeze to realize long-term value. I believe in Ryan. There's more there. The stock went higher. That's my gainers.
All right,
Okay.
You got the gainers, Carol. I got the decliners. Let's start with shares of Booz Allen Hamilton, down more than 8% today. This after the U.S. Treasury Department said it canceled $21 million of contracts with the company after the consulting firm failed to protect taxpayer data, which it had access to, including President Trump's tax returns. The Treasury has 31 separate contracts with the company. It cited the case of Charles Littlejohn, a former Booz Allen employee who pleaded guilty in 2023 to felony charges for leaking records, including the president's tax returns. Also, the trade desk, among the worst performers in the S&P 500 today, down more than 7%. This after the company said the employment of CFO Alex Kale was terminated over the weekend. Kale's been CFO since August 21st. The company did name Tennille Davis, 55, as interim CFO, while the trade desk conducts a search for a permanent successor. And finally, some M&A news, or maybe a lack of M&A news for this final decliner. Revolution Medicines shares falling today by 16. Go ahead and round that up, 17%. It's an oncology company. Shares fell as much as 20%.
That's like a bad EKG line.
Yeah, it is. I mean, it's just been down all day. This after the Wall Street Journal reported that Merck ended talks to acquire the firm, citing people familiar with the matter. Bloomberg Intelligence's team wrote that the decision to end the deal talks refocuses attention on valuation discipline, with the target already up 48% so far this year. Once again, Revolution Medicines down 17% today.
All right, we'll take a quick look at yields. Volatility was incredibly light. So too was volume. Did see a slight tick down on the 10-year yield here, just down by about 1 basis point, if you will. Second straight day of declines here, but again, a bit of a holding pattern, probably ahead of that 2-day Fed meeting that kicks off tomorrow morning.
All right, just got to say, Tim and I love our AirTags from Apple, and they are announcing a new AirTag. It's got longer range.
So
these are the
you
best.
put one on each other so you know what's happening?
Well, we don't go that far, but we put things on lots of other things.
Sometimes I do, I wish everything had an AirTag. Like a pair
I think
of sunglasses.
there are laws against putting them on people that,
Okay. All right.
That was an issue a
Everything.
few years ago. But sorry, Carol, we digress. Go ahead.
All right, so it can now locate lost items from up to 50% farther away. Its speaker is 50% louder than before. And Tim, it's got a distinctive new chime.
Yeah, supposedly it makes it easier to find items that have gone missing. I probably use like the find feature for my wallet or my keys or whatever a couple times a week. This was such a sleeper product a few years ago, and I just think it's one of those things. I'm not, obviously I'm not endorsing things here, but it would do me well to have an AirTag in things that don't actually have AirTags on.
It's on everything in like my household.
Well,
Keys,
I told Carol didn't know this.
luggage,
You can put these on your
backpack.
pets. You can put these on your pets. And Carol was like, I need one for my pet. And I was like, just put one on your pet.
It's got a chip already.
Yeah.
Well, we have both.
Yeah, that's
both.
true.
Yeah.
I don't
You have an
wanna
AirTag on your dog,
I don't
Roman?
want to
We
lose
do,
that.
yeah, on the collar, yeah.
You
And we have a
AirTag
chip.
on the collar?
Yeah.
Can you
In case
just
she gets
call
lost.
for the dog and she'll come to you?
Not my dog. She's obstinate.
I have to say, I wish that I had put one on my wallet, which has been lost for over a month, but I'm doing okay. Muddling
bummer.
through.
The new wallet.
It might still
The
show
new
up.
wallet,
Might
put
still
it on.
show up.
That's what I keep praying for.
I did think it's kind of interesting, though, that Apple kind of would announce this now. It's kind of like everyone's looking for, their developments on AI or Apple Car or whatever big thing, and they're like, hey, man, we're going to actually update this AirTags. It's a good product. I use them
Apple
too.
shares
as well.
did rise
That's not an
today.
endorsement, but I do like them. So.
Yeah.
They did rise on this?
I mean, that's the
Is this
only
what they're going to
catalyst
talk
I can
about on the
find.
conference call?
Maybe. Shares are up 2.9%, so.
All right. Well, something else I'm keeping an eye on, too, is, I know you're all big skiers here. This kind of this ongoing issue now with the United States policies towards non-U.S. Residents, and the idea that you had all these Canadians, particularly up here in the Northeast, that would just kind of cross over into Maine and Vermont and some of the upstate, some of these states here to go skiing. They're not doing it. There was a great story on the Bloomberg terminal about one ski resort in Vermont that actually saw a 35% drop in bookings from its Canadian customers. A lot of these resorts, we should point out, up near the border are heavily dependent on the Canadians coming across the border, so huge financial impact right now.
I feel like, Tim, you have to say something. You're a skier.
Well, I think what surprised me most about this is a great Business Week story. Charles Gorovin writing this piece. I encourage everybody to check it out. But the person who runs the mountain, Steve Wright, he noticed that ticket sales were down. He called 100 of these customers who had not renewed their passes this year to actually hear from them as to why they didn't do it. And he said overwhelmingly he heard about it as a result of U.S.-Canada relations, and he was really concerned about that. Look, I think there is an economic impact to all this stuff. We see what the shakeout ends up being, but this is a nice sort of, microcosm of a real macro story, I think.
And it goes both ways, too. I mean, as somebody who grew up in the Midwest, you would drive up, cross over into Windsor, to did the tax-free shopping and all that, and a lot of Americans aren't going over onto the Canadian side. So, there's impacts on both sides of the border here, and, who knows if we'll manage to work this out or not, but real ramifications.
Hey, guys, what are you doing after the show?
I'm going skiing to Jay Peak.
Are you?
No, I'm going home.
I was wondering if you guys want to go build a snowman. Want to go
No,
buy it?
You know,
again,
we
Miles
tried
Miller
to.
is out there in Central Park building.
I tried to build one yesterday. The snow that we were getting late in the day.
Too late, yeah.
It was not good snow for snowmen.
Fluffy snow, right?
Yeah, it was like a little
for
icy
skiing,
too,
probably.
but
Great
I
for
guess
shredding, though, man. Did you see Sean White was
We
in Central
did,
Park
yeah.
with the snowboard? Yeah.
That was pretty
Yes.
cool.
Yeah.
Pretty cool stuff. All right, guys, have a safe trip home. That's going to do it. Our cross-platform.
Staying here tonight.
Are you? Hey, nobody asked that from me. Or you. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romaine, of course, continuing there on The Close on Bloomberg TV. Tim and I continuing on Bloomberg Business Week Daily right here on radio. We'll see you again, same time, same place tomorrow.
And our coverage continues here on The Close. A big focus on the markets, a big focus on what investors have their eye on. The taco trade, well, now there's a new trade, the Big Mac trade. Ed Clissold over at Ned Davis Research. He joins us just after the break here to discuss why this year's midterm elections will drive markets more than else. That's coming up next here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
I'm just happy you made it in through this massive snowstorm we had here.
I wouldn't have missed it.
Absolutely. Well, you missed a little bit. I'm Romaine Bostic, by the way, and there was a little bit to watch here in the markets here on this Monday afternoon. Modest gains for the S&P 500, modest gains for the Mag 7 in a week where we're going to start to hear from a lot of those big names, including Apple and Microsoft. But the real action that we saw was once again in the FX space and in the commodity space. The Bloomberg Dollar Spot Index down for a third straight day, its lowest levels since 2022. Meanwhile, silver up for a third straight day to, well, yet another record high, maybe evidence, Katie Greifeld, of that debasement trade.
Yeah, it's fascinating. We've been focused on gold, but silver has been absolutely parabolic. We'll continue to keep an eye on that. But let's talk about some of the biggest movers from an equity perspective. I put Apple up there. They report later this week. No clear catalyst that I could find for their 3% rally today, though they are introducing those new AirTags. So go figure. Intel, the fallout continues, down another 5.7% today. That's after this stock fell by 17% on Friday. And then GameStop, we were also talking about this in the simulcast. Michael Burry, he is no stranger to this stock. He's buying more, according to his Substack. Shares higher by 4.4%. But let's get to our top story this hour, and that is Wall Street's appetite. It's shifting from tacos to Big Macs. That is, big midterms are coming. Ed Clissold and the team over at Ned Davis Research believe that this will be the main theme of the year, shifting focus to policy plans that emerge around November's congressional vote. The team writing, quote, President Trump's focus on affordability heading into midterm elections has led to a series of actions targeting oil prices, mortgage rates, credit card rates, and the Fed funds rate, Romaine. So a lot of focus heading into November.
All right, well, let's hear from the man himself. Ed Clissold joins us right now, the chief U.S. strategist over at Ned Davis Research. So, Ed, I mean, you have to sort of break this down for me because, like, historically, I'm always told that elections don't really have a direct impact on the markets. I know longer term, there are policies that come out of those elections that can. But give us a reason why this year, the complexion of this election is going to be a little bit different in terms of how markets should view it.
And usually going into midterms, the market tends to be weak out of the 4 years of the presidential cycle. The midterm year is the weakest, and usually it's Q2, Q3, right, heading into the election, mostly because the stimulus that politicians put into the economy going into the presidential election, comes out, and you really feel that during midterm years. And President Trump is definitely focused on the opposite this time. He knows there's a narrow majority in the House, and if they lose that, then it'll be very difficult for their agenda to get going in the second half of his second term. So he's really focused on juicing the economy, on improving affordability, and projecting national defense, which is something he's been keyed in on for his entire presidency.
Well, I am curious, though, too. I mean, we always know during election years, the politicians always try to sort of address some of the issues of voters, like affordability, if you will, sometimes with substance, sometimes without. I am curious, though. I mean, you have certain states that have primaries coming up, like in a couple of weeks or 3 or 4 weeks for the first one here. And it gets to this idea as to how much can actually be done to actually placate voters or win over voters, if you will, that haven't already made up their mind.
we're certainly a divided country. And so what we're really trying to do here, what the politicians are trying to do are, number one, motivate their base, and number two, fight over the very small group that is actually undecided. And it's going to be a challenge for Trump and the administration because, number one, these things take a while to take effect. It's not like you can wave your magic wand and suddenly an edict, it becomes, goes throughout the entire economy. Number two, some of the things they're trying to do actually counteract each other. If you're going to try to boost economic growth, what that could do is actually push interest rates higher. If you're trying to boost exports, you could weaken the dollar. But if you get better economic growth, the U.S. is a better place to invest, so the dollar could strengthen. So it's a real challenge here. It doesn't mean they're not going to try. And that's the big message here, Romaine, is that the administration is really going to do everything it can, unlike some other midterms where they're a little bit more hands-off.
Well, let's talk about some of the proposals that we've seen so far. You think about credit card interest rate caps that was floated. You saw a big hit to shares of financial companies. You think about the defense names certainly taking a hit when the president basically came out and said that they need to halt dividends and invest in production. And then, we've seen housing stocks also moving quite a bit when it comes to these different measures. Is it fair to say that heading into these midterms that there's more single stock risk or single sector risk than normal?
Yeah, I think that's a really good point, Katie, that rather than focus on the broad market, the administration is going to be keyed in on specific things. Now, again, the challenge is what the left hand might be doing, the right hand might be working against it. And in general, if the market does have a bit of a pullback in the middle of the year, that macro risk could offset, say, industrials are one of the sectors we've highlighted that if the economy does well, that sector should do well. But it's also a pro-cyclical sector. So if you get a pullback in the market, industrials probably won't do as well anyway. So you've got to counteract these things against each other. And so we created this index as a way to really measure whether or not we think the investors are pricing in a Trump victory, not necessarily saying we recommend buying the index, but it's a good thing to keep track of.
Yeah, and it's interesting. I'm taking a look at some of, the implications, some of the key positions that you recommend. This one catches my eye, that you favor mid caps over large caps. Is that more about large caps than mid caps, or what is the logic behind that size preference?
Yeah, there's a couple of things. Number one, mid caps have been underperforming for a while. Last year, they actually did worse than small caps and large caps, which is unusual. It's only happened 6 times, going back to 1979. And so there's some mean reversion there. They also have sector exposure that's a little bit more cyclical. That could help. But also, look, the large cap indices are dominated by the Mag 7 companies, where we're going to have to really prove themselves in a higher capex spend world that their multiple premiums that have been trading at for several years are warranted. Even as of the end of last week, the Mag 7 traded a pretty healthy premium versus what it has over the last 5 years. And so as maybe you see some catch up from good earnings growth from mid-cap companies, you could see that multiple compress a little bit, which would favor mid-caps.
I am curious, Ed, though, too. I mean, when you look at sort of the data of past election cycles, is this going to be one of those situations where we're going to see the market kind of front run this into the November elections, meaning that I guess if it's, let's just assume it's to the upside, where a lot of the gains are going to kind of be either before the actual November election and in the immediate few days following it, and then the market kind of tapers off as we get into the actual, people taking office in the following January?
Yeah, and that's where you have to look at now versus history. What the history has said is actually the opposite of what you just described, Romaine, where there's a lot of consternation over the uncertainty of elections, and then after midterms, the market rallied. But because the administration has been so explicit about what it's trying to do here, it's quite possible we could get a little bit more strength than what you normally get in the middle of midterm years. But again, there's so many things that go into market action besides this. We still want to be careful not to trade just off of what the administration may try to implement here, given that it's going to be hard to get all of that in before November.
All All right, Ed, really great to get some time with you. We really appreciate it. That is Ed Clissold. He is Chief U.S. Strategist over at Ned Davis Research. Now, coming up, crypto traders fleeing to prediction markets. We'll discuss the shift towards event betting next. This is The Close on Bloomberg.
Some breaking news. Shares of United Health, CVS Health, Humana, Centene, all plunging in the after-hours trade. The Wall Street Journal reporting that Medicare Advantage, this is the private version of the federal health benefit for seniors, those reimbursements from the government will effectively not increase at all this year. According to what they're reporting, they're saying that it will rise by just 0.09% for the 2027 fiscal year. The expectation heading into this announcement that it would rise by roughly 5 to 6%, which is roughly in line with longer term averages. This is a big deal, a big source of profits for these companies. And now, citing a recent paper by the Trump administration regarding this Medicare Advantage plan, the Trump administration planning to hold those increases at basically, we'll just call it zero as we round down.
Yeah, and this is just the latest in an ongoing story for these insurers who rely on Medicare. Their profits have been squeezed by rising care expenses. At the same time, that funding from the government, they would certainly call that insufficient. So we'll continue to follow that. But again, the big moves in those big insurers from United Health, CVS, and Humana, you can see it after hours. It'll be interesting to see how that develops. We'll continue to keep an eye on that. But let's pivot now to the world of crypto, because crypto traders, they've actually been cooling on tokens, with Bitcoin plunging 30% from its October peak. Now, as you have fatigue mounting in the space, you've had a shift towards prediction markets, and it's growing. Volumes have been surging across platforms such as Polymarket and CallsEverCore. Let's discuss now with Olga Kharif. She is Bloomberg's senior crypto reporter, joining us now. So, Olga, would we even be having this conversation should we see Bitcoin rallying over the past couple months?
So no, I don't think so. So a lot of the people I talked to for this story, they used to trade meme coins. They used to be very actively trading Bitcoin and building for blockchains and for crypto projects. And then as they saw Bitcoin plunge, I mean, it's still about 30% down from its October peak. As they saw that and they saw prediction markets explode, they basically shifted gears and are now building for prediction markets.
Well, I am curious. It gets to the idea. Is it the chicken or egg effect? Meaning, some of the weakness that we've seen in the crypto space, is that a function of some of these people, I guess, leaving and some of those speculators being out of the market? Or was that already sort of the catalyst and that's just continuing, the inertia, excuse me?
I think this just was a cyclical downturn in the crypto market. It happens about every 4 years or so. And as prices plunged and it became harder for people to make money in crypto, they started shifting to other areas where they can make more money, they feel like. And prediction markets has been a big area for them, because prediction markets are based on blockchains, which are infrastructure underlying crypto. So it's familiar, and it fits with a lot of the people who moved over in terms of they know this, they like the idea of using crypto networks for this.
All right, Olga Kharif there. A great story here on the Bloomberg terminal about some of those crypto traders moving to, I guess, the hotter market right now, which, of course, are those prediction markets. Just real quickly, I do want to go back, Katie Greifeld, to that breaking news that we had at the top of the segment here, with Humana now down 14% in the after-hours trade, CVS down about 10%, United Health, Centene, Molina all moving lower as well.
Yeah, the reporting from the Wall Street Journal that Medicare Advantage payment rates will basically be flat in 2027. For context, analysts from TD Cowen had said that anything below 4% would likely pressure stocks. Given that we're talking about basically no rise at all, it certainly makes sense.
Yeah, we're going to try to get you some more information on this. We'll be back in a moment. This is Bloomberg. Canada, the latest target in President Trump's tariff campaign, warning he'll hit the nation with a 100% tariff if it becomes, in his words, a drop-off port for Chinese exports. It's just one of many comments Trump has made over the last week that has rattled the global ecosystem. Here to talk a little bit more about what's going on is Sarah Bianchi over at EverCore ISI. She's talking about the result there. And Sarah, great to have you here on the program. I am curious here. I mean, coming out of what we heard last week at Davos, a wide variety of comments by Trump, and now this threat towards Canada, our closest trading partner other than Mexico, it gets to this idea as to whether there really is follow through. Is that relationship, as Mark Carney so eloquently put at Davos, truly indeed ruptured?
Well, certainly it has taken a hit. Canada has been upset with the president really since he came back into office, talking about a 51st state and the like. But and I think, look, the speech was very impactful. He certainly sent a strong message. But this news about the China trade deal is actually something I think really any United States president would be concerned about. There are, if we have these tariff-free relationships with our free trading partners, there do need to be concerns about whether or not China is bank shutting through. That was something the Biden administration worried about with Mexico. So that specific grievance, I think, is perhaps more standard, but certainly this relationship has taken quite a hit.
But I am curious, though, too, I think we all kind of understand Trump's game at this point, and he is kind of all or nothing. But there's also been this idea of why there has to be this choice. And I bring this up because there's an interview that just actually crossed the wire that Bloomberg did with Keir Starmer over in the UK. And he was asked about this idea of having to choose between the U.S. and China, or the U.S. and Europe, kind of a similar choice that Carney and a lot of other world leaders are taking. And I understand maybe Trump wants that to be a binary decision, but does it need to be for all of those other countries?
Absolutely not. Each of those countries has its own relationship from a trading perspective with the United States and with China to different degrees. I think actually it's important what the United States has done under again, both the last two administrations, very, very different presidents, Joe Biden and Donald Trump, but both of them worried about supply chains, particularly on a set of products like EVs that have security implications. So I do think there are some things where folks need to be concerned and think carefully about supply chains. We learned that in COVID. But that being said, lots of countries trade with both the United States and China, and the two countries trade with each other.
And Sarah, I do want to turn our attention more domestically focused and talk a little bit about what's going on in Minnesota. We've seen 2 U.S. citizens killed in immigration raids, and news from the president this morning is that he's sending his U.S. border czar to Minneapolis. The hope is that maybe that will help de-escalate some of the tensions here. What does that signal to you as to where President Trump currently stands on this issue and what could happen next?
My read of it is that President Trump understands that he's on the wrong side of this issue, and that while the American people do support some of the things he has done on immigration in terms of tightening the borders, this kind of deportation, this kind of violence is just not where the American people are. And I think Trump is sensing that. I think he's sensing that his Homeland Security his head of Homeland Security is out of touch with what's going on, and that's why he's sending somebody else in. And I expect that's why he had such a friendly call with Governor Walz, and I expect we'll see other changes from him as well.
Well, it's interesting because we're coming up against a deadline for a partial government shutdown. It seems like we're at risk there. There's questions here about whether Senate Democrats would back a funding bill without new curbs on immigration enforcement. So in your words, I mean, the tide seems to be shifting a little bit when it comes to the president's thinking. Do you think that that will be enough to avert the risk of another shutdown at this point?
At this point, it doesn't look like it. It appears that Senate Republicans are wanting to go ahead with a full Homeland a DHS funding within it. I don't think that's going to fly this week with the Democratic Party. Even some of the Democrats in the Senate who were most willing to side with the president and reopen the government in December have come out strongly against. So it does feel like we're at a bit of an impasse. I do think the president is going to have to lean in and show some leadership here if he wants to resolve this before government funding runs out on Friday.
I am curious. There's obviously, this is against the backdrop, of course, of a midterm election season. You have a primary coming up in Texas, I think next week, February. You've seen one in New Jersey, and then they really start to pick up in March. So there's not a lot of time to really get in front of voters and really make it clear and articulate what your policies and plans for them are going to be. I raise that issue, Sarah, because something just broke across the Bloomberg terminal just a few minutes ago about the U.S. government potentially trying to hold Medicare Advantage rates flat on the year. And we don't know a whole lot about this or what the impetus is. But given all the talk about affordability, particularly when it comes to health care, I am curious if you expect the administration to take a little bit more of an aggressive stance in trying to make sure that the costs that most of us see and feel every single day are kept in check.
Well, I think, unfortunately for the president, the way that if these rates from Center for Medicare and Medicaid hold into the final rule, actually what you'll see is a lot of insurers raising their rates. That's what we saw in the Biden administration. The Biden folks did the same thing in 2024. I thought it was super surprising then in election year, and I think it is surprising now. Half of Medicare enrollees are on these plans. So cutting reimbursement rates does save the Medicare program money. Some people believe it brings Medicare HMOs more in line with traditional Medicare. But in terms of what kind of premiums or out-of-pocket costs seniors are going to see, it actually trends in the opposite direction.
All right, Sarah, really great to get some time with you. Appreciate your perspective. That is Sarah Bianchi. She is Chief Strategist of International Political Affairs and Public Policy over at EverCore ISI. Meanwhile, let's take a look at how markets closed on this Monday. The S&P 500 off of session highs, but still higher by about 0.5%, slightly outperforming the Magnificent Seven, a number of which report earnings this week, starting on Wednesday. So looking forward to that. Meanwhile, you saw the dollar fall, the Bloomberg Dollar Index down about 0.4%, and silver right now pretty much unchanged rate in current trading, but we know it has been absolutely on a tear. This is a close on Bloomberg. Well, we are just 2 days away from the first rate decision of 2026, with the Fed expected to keep rates on hold. Now, the timeline for a cut has moved further out given sticky inflations and also signs of stabilization in the labor market. Joining us now to discuss is someone with some interesting insights on the job market and how AI is changing everything. Ben Zweig, he's the author of Job Architecture, Building a Language for Workforce Intelligence. He's also the founder of Revelio Labs, a workforce intelligence company. Ben, it's great to see you in person.
Thank you for having me. It's good to be here.
So I do want to talk about AI, but let's zoom out a little bit and just talk about where we stand with the labor market. As I said, there's some signs of stabilization. We're getting the next labor report next week, I believe. I mean, what do you make of where we stand right now? Because it certainly feels like some of the worst fears that maybe we were talking about a couple of months ago haven't exactly come to fruition.
Yeah, I mean, not that much is happening. We're in a very low hire, low fire market. And when I say low hire, no fire, I mean like low separations generally. So layoffs are not tremendously high. There's some concern that would be higher. And quits are really low, really historically low. So really very little is happening. We're still shrinking kind of as, relative to where we would need to be at a stable unemployment rate. So we're adding roughly 25, 50,000 jobs a month, which is low. We need about 200,000 to kind of break even.
Yeah, it feels like it's this sort of unhappy equilibrium that we found with the labor market. Let's talk about how AI is impacting things, because you hear a lot of consternation about what this means for entry-level jobs, the existential fear out there that AI is just going to take over entry-level jobs, and really it's going to make it difficult for a lot of these young workers who are at least trying to enter the workforce. What have you seen so far?
So the evidence we see is pretty troubling for younger workers, that for younger workers who are exposed to AI tasks, the demand for those types of workers is reducing dramatically, like a lot more than older workers who are also exposed to those tasks. So there's something to do with AI exposure and age kind of interacting. So we don't really know exactly what drives this, but I think the best read on it is that it's probably anticipatory. It's probably that firms are expecting that they can automate these workers and maybe don't want to take the bet on a younger worker, whereas a more experienced hire is just a safer bet generally.
Do you have any sense, though, whether that might actually come to fruition? Because there's been a lot of mainly anecdotes, this idea of what you said, but also the idea that we could actually see a hiring boom when a lot of these companies realize that the AI isn't up to snuff to replace all the people they thought they were going to be able to replace.
Yeah, I think that's likely. I mean, in some ways, supply creates its own demand. So, I don't think we can expect the reduction in demand for younger workers to continue. They're going to be productive. They're going to find jobs. I do think we'll see some, wage divergence between younger and older workers, because they're, with AI, one way to think about what AI does is that it's really executing on tasks, not orchestrating between tasks.
Yes.
And we can think of a job as a collection of tasks. So if we think about orchestration and coordination, those are really the skills of older, more experienced workers. And younger people generally don't have that much experience coordinating and orchestrating.
There's a big question, though, too, also, as sort of AI and the ancillary technology evolves, this idea, are newer jobs going to be created? So what I want to know is the aggregate number of jobs basically going to be more on a per capita basis 10, 20 years from now, or are we just going to look at a much smaller workforce? Is that our future?
Yeah, so I think, in the short term, labor demand really drives, the ebbs and flows of the job market. In the long term, labor supply really drives that. So I think, we'll see some matching of the capabilities of workers and how firms can kind of, reallocate.
When you say labor supply, you're basically saying that the government, or at least our economy, has to find a way to employ these people one way or the other. Or
exactly.
they revolt and, overthrow the government.
Something like that. I hope not.
Sorry, not to be too dark, but.
Yeah, I mean, I think there are reasons to be concerned about will we see a reduction in labor supply? But I think those concerns are really more about demographic shifts, low birth rates, low migration rates. Like those are troubling. I wouldn't see AI as something that would affect the long-term prospects for employment generally, because we already are seeing more adoption of new roles. I mean, we had a piece last week about consulting firms. So now consulting firms are hiring these AI roles, new roles they didn't employ before, and those actually exceed the number of entry-level consultants.
Okay.
Which is kind of wild, because we think of consulting firms as this launching pad for early career hires.
Yeah.
And that's less the case now than it has been even in recent years. Yeah.
Ben, I'd also love to get your thoughts on the potential opportunities created by AI. When we talk about AI in the labor market, it's easy to get depressed. But we heard from Jensen Huang, of course, the NVIDIA CEO, last week. He is optimistic that AI is going to create jobs, specifically jobs related to tradecraft. He specifically mentioned plumbers and electricians and construction and steel workers. He's not alone in that. You also had a McKinsey report basically estimate that you're going to see big demand when it comes to trained electricians, as well as construction laborers and construction supervisors. And we're just talking about the U.S. here. I wonder what you make of, some of those types of predictions. And I will say it's somewhat ironic that, you have the CEO of NVIDIA saying that, since, it's the technology that he's helping to create that could kill a lot of these entry-level jobs.
Right. So we got to take it with a grain of salt. I mean, I think that's probably right, that we're going to see demand for new types of electricians and stuff like that, people building data centers, supporting this technology. I think that's a secondary story. I think the bigger story is about how each job is going to change. So, sometimes we think about technology as affecting jobs as the unit of analysis. But something that I think we need to, take a step back on is that AI really doesn't affect jobs wholesale. Jobs don't really ever get automated by technology all at once. There are really components of jobs. So, these jobs as bundles of work activities, as bundles of tasks, some set of tasks get automated. It's hard for me to say tasks, but some of those get automated, and that means that the job itself kind of has to reconfigure. So, we always think back to the story of bank tellers when ATMs got introduced. That's like this classic story. But what really happened wasn't an increase in the demand for depositing and withdrawing money.
Yeah.
It was actually a reconfiguration of that job. So now bank tellers don't do what they did in the 50s and 60s. They do customer support, customer service, relationship management. And I think that's what we're going to see with jobs today. Every job is going to look a little different.
Yeah, that is interesting too. Yeah, the bank teller thing is interesting too because there was so much consternation about that, and it just kind of evolved into a different job. I have to get you back to talk a little bit more about this, Ben. Ben Zweig is the founder over at Revelio Labs and also the author of a new book called Job Architecture. When we come back, we're going to continue our focus here on the economy and consumers feeling the pinch of record high beef prices. A conversation up ahead with the CEO of Omaha Steaks, Nate Rempe. Stick with us. This is Bloomberg. Beef prices holding at a record high, with the average consumer paying about $7 a pound for ground beef. This as the Trump administration's new dietary guidelines are set to actually boost demand for the protein. Meat's at the top of that food pyramid, the inverted food pyramid, if you will. Joining us right now is a man who knows a lot about beef. Nate Rempe joins us right now. He's the CEO over at Omaha Steaks. Well, first is first. I'm sure when you saw that inverted pyramid, that had to have been music to your ears, Nate. The idea that at least you have the government's backing in us eating more beef. But of course, it also comes at a kind of precipitous time where prices are at elevated levels here. Kind of square the circle for us as to where you think this goes.
Yeah, I mean, demand is at an all-time high. Having a ribeye at the top of the pyramid there is certainly going to lift demand at a time where supply is at an all-time low. It's not something we haven't known. We have always known at Omaha Steaks that that beef is a high-quality, complete protein that's good for for the human body, and it's delicious, and so it's not a surprise it's there. But certainly, being at the top of the pyramid and the U.S. government coming out and pointing that out is going to drive demand, and so it's going to further exacerbate what we've been seeing on price.
I am curious though too, like what options, like if you are a consumer who is very cost conscious for whatever reason or another, like are there really cuts anymore that are affordable? I mean, like I remember when I was young and starting out my career, you'd buy the flank or the hanger steak or something else because it was a lot cheaper than the sirloins or ribeyes. But now I feel like those sort of butcher cuts, if you will, have been in vogue now. I mean, you're paying like a ridiculous amount for oxtails, and that used to be just like throwaway meat back in the day.
The beef market is just riddled with options. Really, it is. The thing that you think about is a number of things, right? There's all kinds of cuts. I mean, you mentioned the sirloin. That's a really lean cut. It's really affordable, but still delicious. The lean points in ground beef is something that, the educated consumer really needs to be thinking about. But the other thing, Romaine, that's interesting is the portion size. It's something that people often don't think about. You go to the grocery store, you buy this big cut of meat, and you eat 2/3 of it. Really understanding your portioning can be a really effective way to manage the impact of rising costs of really food in general on your wallet. So, at Omaha Steaks, we've got all kinds of good options there, from a 5, a 6, a 7, an 8, a 10-ounce steak and on up. And so thinking about how much you want to consume and doing a little bit of planning there can be a really effective way to manage the rising cost of beef and its impact on your wallet.
That's really interesting. We were talking about smaller portion sizes in the context of restaurant chains last week. It's interesting to hear how it's sort of translating into your world as well. So have you introduced new, smaller portion sizes, or are you just saying that you're seeing consumers maybe go after some of those smaller sizes?
I think people are starting to realize that they don't need as much, particularly when you're eating a complete protein. I was kind of laughing earlier today thinking about, really the only meal that I ever eat where it's only one thing on a plate is a steak. Because it's so, it's so filling and it's, like I said, it's a complete high quality protein. So, thinking about what your intake is, I think is an important part of the dietary guideline. And it's a way that America can really think through that. Another piece, Katie, that I think is ironic is that at the top of that pyramid is a ribeye. Now, a ribeye, it tends to be the more rich cut of steak, a higher fat point there, as opposed to a sirloin, which can be a much more leaner cut, although still bold and delicious. And certainly if it's coming from Omaha Steaks, just as tender as a grocery store filet mignon. And so, the educated consumer that thinks about portioning, explores the optionality in beef, is going to be the consumer that wins amidst this high demand, constrained supply market.
I gotta say, the cartoon ribeye, it just looks good, Nate, but I hear what you're saying. It's
Yes.
always great to check in with you. Really
Fat is
appreciate
flavor,
it.
Nate. Fat is flavor.
Fat is flavor.
You don't need to tell me.
That's true. That is Nate Rempe. He is the CEO of Omaha Steaks. Really interesting conversation. And yeah, it is interesting that the food pyramid spotlighted beef at the same time when you do have prices at pretty much record highs.
Yeah, and we should point out there's a chicken up on the top of that chart, and I think cheese and some other things. So there are fish as well. So there are the protein options, but obviously Nate, has to talk his book, obviously being the steak guy. All right, let's set you up for what to watch over the next 24 hours because things are about to get busy. Earnings season in full swing, the second busiest week in terms of the number of companies reporting. Let's start in the morning, Katie Greifeld.
Yeah, absolutely. We have Boeing, UPS, General Motors, American Airlines, United Health, which will certainly be interesting after the news we got from the Wall Street Journal today. And then we have Texas Instruments after the market, which we'll be breaking down.
And also, I know it's a European company, but let's pay close attention to LVMH. Obviously, they're dealing with a lot of issues with consumer spending trends, also tariff trends, and the like as well. So maybe a read there. Meanwhile, back here in the U.S., we do get some economic data, including a read on consumer confidence.
Yeah, absolutely. That coming from the Conference Board. We also get Richmond Fed manufacturing, as well as the house price index from the FHFA.
And India is going to be a big focus this week. There's a bunch of summits going on, including that big EU-India summit in New Delhi. And of course, this comes at a time where a lot of our traditional trading partners here in the U.S. are looking for alternatives. It'll be interesting to see what happens there.
Have to imagine the U.S. will be the elephant in a lot of those conversations, though.
Absolutely. Well, speaking of which, Balance of Power is up next at the top of the hour for all your political news right here on Bloomberg.